All right, let's dive right into this explainer. You know, you hear financial creators say it all the time. Put your money to work. But honestly, what does that actually mean? Well, today we're going to break it all down. We'll visualize exactly how to get your money working way harder than you do, exploring the most common types of investments so you can build what we love to call your very own army of dollar bills.
It's a pretty huge problem, right? We hear invest your money nonstop, but then nobody actually tells a brand new investor what to go out and buy. It leaves you completely overwhelmed, kind of like our little stickman doodle. It is so easy to just freeze up before you even begin. So let's clear up all that noise. We're going to use some fun, visual analogies to map out exactly what you should be buying.
Here's our roadmap for today. First, the army of dollar bills. Second, stocks and bonds explained. Third, the egg carton approach. Fourth, the index fund secret. And finally, set it and forget it.
Kicking things off with Section 1, the Army of Dollar Bills. To actually get this army working for you, we have to start by identifying the forces you can recruit. Basically, we assemble them from 4 main asset classes. You've got stocks, bonds, mutual funds, and exchange-traded funds, which most people just call ETFs. Now, these are the fundamental building blocks of your wealth. We are definitely going to reveal one highly specific, absolutely game-changing subcategory later on. But first, we got to get aligned on these core 4.
Moving right along to Section 2, Stocks and Bonds Explained.
First up is the one you've definitely heard the most about, stocks. Look, when you buy a stock, you are literally buying a tiny fraction of a single publicly traded company. Just picture the biggest brands on the planet. Apple, Walmart, Amazon, Nvidia. Buy their stock and boom, you're a part owner. The whole idea here is that hopefully the company's value goes up over time, giving you some sweet gains when you eventually sell it, plus any extra income it happened to kick out along the way.
Then we have the much more conservative sibling, bonds. Think of a bond as a loan, except in this scenario, you're the bank. You lend your money to an institution for a fixed set amount of time. In return, they agree to pay you back, plus a little extra, which is your interest. Usually, they'll pay you that interest regularly throughout the life of a loan. And then, when the term finally wraps up, the bond matures, and you get your original chunk of money back, along with any remaining interest.
So when we put these two side by side, the contrast is super stark. Stocks, they have the potential to completely supercharge your wealth, no doubt about it. But they pack a lot of risk. Pick the wrong single stock, and yeah, that investment could literally go to zero. Bonds, on the other hand, carry way less risk. They're definitely the safer bet, but the trade-off is a significantly lower return.
That brings us to Section 3, the egg carton approach.
Okay, I absolutely love this visual. If holding a single stock is like walking around with one super fragile egg, then mutual funds and ETFs, they are the whole protected carton. By grouping tiny fractional pieces of multiple assets together, you get this amazing built-in diversification. You're holding tons of assets in one single fund, which means far less risk than betting on one stock. You aren't trying to guess if one specific business is going to win. Instead, you're essentially betting that a whole sector of the economy is going to grow over the coming years. It's a brilliant way to picture getting solid returns over a long period, but with way less of that stomach-churning volatility. Now, mechanically speaking, they do act a little differently behind the scenes. ETFs trade all day long, exactly like a normal stock does. Mutual funds, though, are only bought and sold after the market closes for the day. There's also a slight difference in their tax structures, but honestly, the absolute most important takeaway here is that fundamentally, both of these tools serve the exact same brilliant purpose: diversifying your money across a whole bunch of companies at once.
Let's dive into Section 4, the index fund secret. All right, cue the drum roll, because this is our absolute favorite tool in the financial toolkit. Enter the index fund. This is a highly specific type of fund that's designed to mimic a specific segment of the market. The classic example is the S&P 500, which basically represents the 500 largest US companies.
An index fund just quietly tracks how those 500 companies are doing, giving you instant exposure to a massive slice of the market. And because they're passively managed, meaning you don't have a bunch of highly paid guys in fancy suits actively buying and selling stuff behind the scenes, the costs stay incredibly low. And get this, historically, these simple, boring passive index funds actually outperform the vast majority of those active stock pickers over the long haul. How crazy is that?
But here's a massive misconception we really need to clear up. An index fund isn't some completely different, totally separate thing from mutual funds or ETFs. Actually, it's just a strategy. Both mutual funds and ETFs can act like an umbrella that's built to track an index. So whether you're using a Roth IRA, a 401k, or just a regular brokerage account, using index-style mutual funds or ETFs is arguably the single best place to start your wealth-building journey.
Which brings us to our final part, Section 5. Set it and forget it. Now, if picking out specific index funds still sounds like way too much work, don't worry. We have an even simpler, ultimate low-stress blueprint for you. Index Target Retirement Funds. These funds literally do all the heavy lifting for you. They're essentially index funds that automatically adjust and rebalance themselves as your target retirement date gets closer. They tweak your risk based entirely on your personal timeline of when you actually plan to retire.
For example, look at a 2030 target retirement fund. Because that target year is rapidly approaching, there really isn't much time to recover if the market suddenly crashes. So, the pie is heavily weighted towards safer bonds. You've got a large slice for bonds and a smaller slice for stocks, which ensures the fund is intensely focused on minimizing your risk of losing money right as you're about to retire.
But then, flip it around and look at a 2065 fund. Our little stickman doodle has decades before he's going to be kicking back in a hammock. Because retirement is so far away, the fund is heavily weighted in stocks. You get a massive slice of high-risk, high-reward stocks and just a tiny little sliver of bonds. It maximizes your growth potential, letting you fully ride the wave of the stock market, knowing you've got plenty of decades to smooth out any temporary bumps. So if there is one absolutely crucial point you take away from this entire explainer, it's this. When you're just starting out, please do not obsess over squeezing out an extra tiny percentage point of return by picking individual stocks. Look, everyone has different needs and risk tolerances for sure, but your savings rate, meaning the actual cash you manage to squirrel away, matters so much more than your rate of return in the beginning. Keep things incredibly simple. Use index funds or target retirement funds and just focus all your energy on mastering your own behavior, putting as much money into those accounts as early as you possibly can. And that brings us to the single most important question you need to answer today. Since the absolute easiest, lowest stress path forward really only requires knowing two simple things, how much you want to invest and when you want to stop working, it's time to draw your goal line in the sand. So, what year are you aiming for? Figure out that date, recruit your very own army of dollar bills, and let the market do the heavy lifting for you.
Freedom isn't given, it's built, and it starts with what you do next.